Hello. In this video, we're going to talk about corporate liquidations, looking at corporate tax consequences. This is corporate liquidation problem 1. This video is going to follow along with the corporate liquidation checklist that we've already looked at. Pineapple Express Incorporated, a C corporation, was found many years ago to provide private charter flights to Hawaii. Coconut owns 600 out of 1,000 outstanding common shares of Pineapple Express. And by the way, for this problem, assume this is the only type of stock out there. Coconut, an individual, so Coconut's an individual, acquired 400 of those shares for $50,000 20 years ago. Coconut acquired the other 200 shares to make up 600 this year for $1.9 million. Pineapple Express decides to liquidate. The corporation sells its assets, which the adjusted basis of the assets are $1 million, for $10 million cash. So Pineapple Express is going to then distribute $6 million of that $10 million, because there's 60% ownership to Coconut. So $6 million of the $10 million cash goes to Coconut in complete liquidation. And then also note that there's total EMP of the corporation of $7.4 million at the date of the complete liquidation. Okay, so the first thing to note here is that we have a complete liquidation. Whenever you have a corporate tax issue, remember there's multiple hats you have to think about, or put different hats for different situations to put on. Could be a formation problem, could be a distribution problem, could be redemption, could be debt versus equity. This is complete liquidation. Because we have a complete liquidation, which the problem tells us, that means we apply the complete liquidation checklist. So we have a complete liquidation, a form of liquidation under section 346. We go to our complete liquidation checklist. Now remember, when it comes to complete liquidation, the checklist, there's really two sets. There's the general rules found in section 331 and 336. And there's also the special non-recognition rule for liquidation of subsidiary, which is section 332 and 337. The way I like to think about it is, of course, the general rule is going to apply unless we have that special rule. For the special rule to apply, we have to have a parent corporation owning another corporation, and that parent corporation has to own 80% or more. Well, here, because Coconut owns 60%, which Coconut's an individual, that means the remaining 40%, whether it's owned by a corporation or not, is not going to qualify for the special subsidiary liquidation test. Because you have to own 80% or more, which Coconut does not, and you have to be a corporation owning another corporation, which Coconut's an individual. Therefore, the special subsidiary liquidation rule does not apply. We're applying the general rules of complete liquidation. The general rules. Now, one thing I want to note is there's going to be two variations in this fact pattern. This is variation 1. Variation 1, again, is where there's a $6 million distribution to Coconut, and there's a $7.4 million EMP by the corporation. So remember, when we do these consequences, we have to focus on calculating the consequences to the shareholder, here Coconut, and also we need to look at the consequences to the corporation. So that's Pineapple Express. Pineapple Express. So let's focus on the shareholder's consequences, Coconut. So remember, the way we calculate the consequences, we do the normal sale or exchange under the general rule, amount realized minus adjusted basis. Amount realized is what Coconut's getting. Coconut here is getting $6 million of cash. $6 million of cash. Minus adjusted basis. The adjusted basis is going to be the basis in the stock that Coconut has. So Coconut has a basis in 400 of those shares of $50,000, and then the remaining 200 shares, $1.9 million. Under the cost basis principle under section 1012, we add both of those together. We have a cost basis of $2 million. I'm sorry, my apologies. Jumped the gun. That's wrong. Of $1,950,000. So $6 million minus $1,950,000 is going to be $4,050,000. $4,050,000. And that's going to be the amount of gain. Okay, let's come back to the characterization because that's going to bring up an interesting issue. Okay, let's come back to the characterization issues. Pineapple Express. Pineapple Express also has amount realized minus adjusted basis. The amount realized is always going to be the greater of the fair market value or the liability on that amount. Here there's no liability. It's just simply a distribution of cash. So it's going to be the cash. I'm sorry, my apologies. It's going to be the fair market value of the property at the date it sells. My apologies. At the date it sells. See, I jumped the gun there. Okay, when it sells the assets. So it sells it for $10 million cash. There's no liabilities told to us in the problem. And the adjusted basis of that property is $1 million. So Pineapple Express has a $9 million gain that must be recognized. The character of that gain is whatever the asset is. If it's a business asset, let's say Section 1231, it'll be a $9 million Section 1231 gain. If it's a capital asset, it'll be a $9 million capital gain. Whatever, okay? We don't have the facts to determine that character, but you would look at the actual character of that asset. All right. So now we look at the characterization of Coconut's gain. So we know it's going to be a capital gain. We know it's going to be capital gain, but here's the issue. Part of those shares were acquired long-term, more than a year ago, while part of the shares were acquired short-term because it's required this year, so a year or less. So part of this gain is going to be long-term capital gain, and part of the gain is going to be short-term capital gain. Okay? The way we calculate this under the tax law, there's multiple ways we could allocate this, but the way we do it is actually we use the number of shares. So we have 600 shares total, and we break up the amount realized. Okay, so 200 over 600 and 400 over 600. We're going to multiply those numbers, okay, 200 over 600 and 400 over 600, and we're going to multiply that by the amount realized of $6 million. Okay? So this is going to give us $2 million. This is going to give us $4 million. We then use those, okay? The $2 million is the short-term amount. The $4 million is the long-term because that comes from the 400 shares that were acquired 20 years ago. $2 million comes from the 200 shares acquired this year, so that's short-term. Now what we're going to do is we're going to basically recalculate the $4,050,000 capital gain using the short-term and long-term amounts. Okay, short-term and long-term. And we're going to use the basis with respect to those amounts. Amount realized adjusted basis. So the amount realized of the short-term, that's the $2 million that we just calculated. The adjusted basis is the cost basis of that, which is at $1.9 million. $1.9 million. Long-term is going to be the $4 million amount realized. We just calculated that. Minus the adjusted basis of the $50,000. Okay, so we get the short-term capital gain. That's going to be $100,000. We get the long-term capital gain, which is going to be $3,950,000, which if we netted these two numbers together, we would get $4,050,000. So that means of the $4,050,000 capital gain, $100,000, my apologies, $3,950,000 of that is long-term capital, and $100,000 of that is short-term capital gain. And that's how we calculate and break up that $4,050,000 capital gain. And that, we've just now calculated all the tax consequences of variation 1. The last thing to note is that the EMP, there's no effect on that because since we're complete liquidation, that just goes away. It goes bye-bye, right? It's gone. If we had the subsidiary rule, the special non-recognition of the parent subsidiary rule, then it would carry over, but we don't have that here. So that's variation 1. All right, so now we have variation 2. In variation 2, the facts above all stay the same up here. The only thing that changes are these two bullet points. We have Pineapple Express distributes $300,000 rather than we saw the $6 million in the previous problem, okay, to Coconut and complete liquidation. And all EMP is negative. All EMP is negative. Okay, so we go through the same consequences, the same determinations. Again, we realize that it's a complete liquidation here. And the special subsidiary rule does not apply because, again, Coconut owns 60%. Coconut's an individual. Boom, no special subsidiary rule here. So we have the general rule, 331, 336. Okay, the general rule. General rule applies. So we're going to go ahead and start with, this time, we're going to determine the consequences for Pineapple Express because, as you saw last time, that was actually a lot simpler. So amount realized is the amount on the sale of the asset. Okay, the sale of the asset. When it sells its assets, it gets $10 million cash. So amount realized is $10 million. Remember, that's the greater of the fair market value or liability relief. There's no liability relief here. So amount realized is $10 million minus the adjusted basis of the asset. The asset here is basis is $1 million. $1 million. So we have a $9 million gain. That gain, the character of that gain is whatever the asset is. So if this is a business asset, it's probably going to held for more than a year. It's going to be a Section 1231 asset most likely. Okay, so that's the effect of Pineapple Express. And by the way, the EMP has no effect. It doesn't change anything. It goes away. It's going to disappear. That has no effect on the problem, the EMP. So now we have to do the consequences for Coconut. And just like we saw last time, we're going to have to break up that amount realized. But I always like to start by looking at the total amount realized minus adjusted basis because that gives us the total amount. So amount realized is what's going to be received. Amount realized here is $300,000 minus the adjusted basis of the stock. The adjusted basis of the stock is $1.95 million. That didn't change from the last one. We add these two numbers together. So we get $1,950,000. So we take $300,000 minus $1,950,000. We get a loss of $1,650,000. That's going to be a capital loss. So we're going to have to break up that capital loss between short-term and long-term, okay? And the way we do that, again, remember, we take 200 over 600 and also 400 over 600, right? The 200 over 600 is the short-term portion because that is the, right here, acquired in the last year, during this year. And we're going to multiply that by the $300,000 of proceeds received. And the long-term is going to be the 400 shares acquired 20 years ago times $300,000. So that's going to be $100,000. And this is $200,000. Okay? $200,000. All right. So now that we have this information, we need to do short-term and long-term calculations using our amount realized and adjusted basis. Okay? Minus adjusted basis. And that's going to give us the short-term and long-term capital gains, capital losses. So amount realized for short-term, we have $100,000 minus a basis of $1.9 million. For long-term, we're going to have $200,000 minus a basis of $50,000. Now we can get our amounts. So here we're going to have a actual short-term capital loss of $1.8 million. And then here we're going to have a long-term capital gain of $150,000. So notice in this problem, even though we have an overall capital loss of $1.65 million, we have a short-term capital loss and a long-term capital gain here. Short-term capital loss of $1.8 million, long-term capital gain of $150,000. Interesting, right? Yes, it nets to a negative $1.65 million, but you see that it's different. It makes a big difference here. So those are the consequences of Coconut. Consequences of Pineapple Express, $9 million gain characterized by that asset. And again, the EMP just disappears because it's not the special liquidation rule where it actually rolls over to the parent, the subsidiary does. So therefore, this is the end of the problem. We finished problem 1. So please stay tuned to other videos to learn more about corporate liquidations.